So good afternoon, ladies and gentlemen. Ladies and gentlemen, could you please take a seat? So let's kick off in the afternoon session, Activity-Based Approach to Systemic Risk. Before kicking off, just one thought. We are very happy because sometimes we don't remember what happened in the past. So, bad things happen, but we don't remember or we forget. But gradually memory, we just don't have to remember or just to memorize all the bad things. But I still remember what happened 2008, what happened after Lehman crisis, AIG crisis occurred. And the key question is, the world is safer now or not? And all of us here, we did enormous effort to analyze systemic issues in the insurance sector or interlinkage between insurance and other financial sector. And as you know, we developed methodology to analyze, evaluate, assess systemically relevant companies. We identify systemically relevant insurance companies and also policy measures. And last year, we reviewed that methodology and improved it. And again, we further review this assessment methodology in addition to now activity-based approach. So we hope that at least our area, insurance area, the world is safer. But we don't know. And this journey will continue. And now the new development activity-based approach is a key theme. What does it mean? Where we are and how it will evolve. Again, this is excellent panelist members. I will introduce Alberto Corinti. Alberto is leading this systemic risk discussion. We call it a man of systemic risk. Not create systemic risk, but address systemic risk, of course. So he knows. So he took a lead, as you know, NTNI revision and also current activity, systemic risk assessment task force leader in the association. And of course, our panelist is excellent who involve all these issues for a long period of time. So just Alberto and the colleagues, yes, please start your discussion. Thank you.
Yoshi, thank you also for your presentation. I think you made me more important than what I am, actually. And but I'm happy to be here to facilitate discussion about what IAIS is doing in terms of in the field of systemic risk. And as Yoshi explained, this panel will be mainly focused on how IAIS is working to develop, the approach to systemic risk, including on the activity-based approach to systemic risk. But we thought it was for the sake of completeness, it was useful also to describe what IAIS is doing now for implementing what it is currently in the regulatory framework. Having said that, let me introduce my colleague, and even though you should know them even better than myself, and Elise Liebers, who is acting chair of the IAIS Financial Stability and Technical Committee, senior director of NAIC, and the Financial Stability and Technical Committee actually is carrying out the concrete implementation of the current systemic risk framework in IAIS. On my right, Steven Seitz, Deputy Director of FIO, Federal Insurance Office in US Treasury, who is the Vice Chair of the Systemic Risk Assessment Task Force in IAIS, and also co-chair of a joint group that has been established together with the Basel Committee to deal with the cross-sectoral aspects. We will discuss then later. So having said that, I think a good starting point would be to ask Elise to describe what IAIS is doing at the moment in the assessment of systemic risk.
Thanks, Alberto. Okay, thank you, and hello again. So the IAIS activities-based approach is certainly attracting a lot of attention and resources this year, and I would venture to say that this project, the activities-based approach, along with the ICS, are probably the most high-profile projects that the IAIS is undertaking this year. My remarks are intended to remind you all about some important work that is ongoing on systemic risk. It's ongoing as we speak, and that is the work to identify individual firms as globally systemic. And you'll sometimes hear this referred to as the entity-based approach, as opposed to the work that Alberto and Stephen will talk more about today, which is we refer to as the activities-based approach. So the development of the entities-based approach began in 2013, and the goal was to identify insurers whose distress or disorderly failure would cause disruption to the global financial system and economic activity. And the work involved the development of approximately 15 or so quantitative indicators that significantly focused on the assessment of firms' interconnectedness and non-traditional non-insurance activities. It was a methodology that was and largely still is based on a relative ranking of insurers for each of those indicators. And this was very similar to an approach that had been taken by the Basel Committee. In 2013 and 2014, we also considered enhanced policy measures that would apply to firms that have been identified. We developed a higher loss absorbency capital requirement, as well as policy measures that related to the need for a systemic risk management plan and also a liquidity management plan. Now in 2016, there was a major overhaul of the methodology. And in particular, there was a build-out of some of the more qualitative aspects of the G-SII assessment. And in particular, the need to do a deeper dive and investigate certain areas where we felt that the indicators didn't tell the whole story. And there was an attempt to clarify. There was a significant overlap in the methodology between what we refer to as non-traditional non-insurance activities and the interconnectedness category of the methodology. And this resulted in a reorganization of the indicators into ones that focused more on the primary transmission channels for systemic risk, which was asset liquidation and macroeconomic exposures. So on this slide, you see a description of the 17 indicators. These are the quantitative indicators. And on the right side of the slide, you see the various processes of the various phases of the methodology. This is the 2016 methodology. And I know that sort of many of you that have followed developments are well familiar with these phases. There was a major rollout in 2016 of the methodology, so you're probably familiar with them. The first phase is the data collection phase, and that's where we're collecting data from approximately 50 companies, 50 of the largest companies with international activity. In phase 2, that data is analyzed by IAIS members who send their analysts to Basel. They're spending quite a bit of time in Basel. They have weekly calls, and then they spend weeks at a time in Basel validating the data. That might involve checking the data against some public documents. It might involve going back to the supervisors and doing some reasonableness checks on the data. The second phase also involves the development, it also involves actually running the data through the indicators. So you actually see how the company scores on the quantitative indicators. And at the end of that process, there is a determination of which companies exceed, there's a determination of a cutoff and which companies should be moved to the next phases of the methodology. So once that's determined, companies below the cutoff is no longer analyzed through the methodology, and those that exceed it move to phase 3 of the methodology. Now, phase 3 of the methodology is the qualitative aspect. It considers, as I was saying before, certain information that goes beyond the 17 indicators, really opportunity to do a deeper dive on these companies. And again, at the end of phase 3, there's a determination of which companies move forward to phase 4 of the analysis. And in phase 4, there is an opportunity to engage with the firms, have a discussion with the firms, and clarify any points that might be still outstanding, and also answer questions. And in phase 5 is the last phase. That's when the IAIS makes recommendations to the FSB on a cohort of potential G-SIIs. And that typically happens in the fall. Okay. So where are we currently? Well, we're currently using the 2016 methodology. We launched the data collection in March of this year. I would say each year the data collection process goes more smoothly. Each year the companies are more familiar with the definitions of the data items. The analysts get a lot of questions back from the companies, and each year I think do a more effective and efficient job of running the analysis. And that phase of the work has resulted in the running of the indicators, as I said. And earlier this week at the Financial Stability and Technical Committee, we made a decision on which companies shall advance to the next phases of the methodology. So I'd like to just say that although the whole process is running much more effectively now than in the past, I would say that there are still issues that exist, and I just want to highlight a few of them because I think it will help you understand more about how the work of the Systemic Risk Assessment Task Force fits in, how it's related to the entity-based approach, because they are all interrelated, and the IAIS is trying to take a much more holistic view of systemic risk. So one area where we've identified work is needed is actually in the use of relative rankings. And in particular, for some indicators, a relative ranking makes a lot more sense than for others, and we're trying to look more toward the use of using absolute reference values rather than just comparing each firm to the sum of all firms in the sample. So we made some progress in that regard in 2016, and we're looking to make further progress on that. So a second area that we've identified that needs further work, is related to the treatment of insurance groups that have significant banking or bank-like activities. And this is because our G-SII formula puts very significant emphasis in the formula on these activities. And we want to make sure that the results that we're seeing from our G-SII analysis are coherent and they make sense for companies, and they make sense in light of the G-SIB analysis that's taking place also at the Basel Committee. I want to make sure that we're producing coherent results. A third area to highlight relates to the asset liquidation transmission channel, and particularly on improving measures of liability liquidity risk. So in our indicators, we do try to get at liability liquidity risk, but we think that this might be an area we could improve. We can improve the types of information that we're asking for and get a better picture. Well, I could go on. I think that each of the IAIS members, and probably the firms too, have their priority list of things that they would like to see improved. And I'm also aware that the firms would like to see more transparency in the process overall, and we're working our way through that. Let me say that what we plan to do is the next round of revisions in the formula. We intend to do that in 2019. 2019 would be the next 3-year cycle for reviewing the formula. And so it's likely that any sort of major revisions will take place at that time. And for this year, in terms of how it compares to 2016, I would characterize the methodology as largely the same as 2016, but with some clarifications and in a few cases implementing decisions that had been taken in 2016. But importantly, I guess for our panel session today, and Alberto and Stephen will talk more about it, these revisions that I've talked about will be recommended by this new Systemic Risk Assessment Task Force. And as you hear Alberto describe the mandate of the group, I think you'll understand more why it makes sense to have the group do this work. Clearly, the work on identifying activities that might be systemic is also going to have relevance for the entity-based approach. And the cross-sectoral work that Alberto will talk about will be useful in addressing the treatment of bank-like activities in our entity-based methodology. So there's a lot of synergies between what's being done in the activities-based approach and how that might impact the entity-based approach. So with that, I think, Alberto, I'll turn it back to you. Okay.
Thank you very much, Elise. I think this is a good introduction for explaining the work of the Systemic Risk Task Force. Actually, IAIS had to do, in developing its approach to systemic risk, at least 3 things. The first one, as Elise has explained, is to review the methodology for the designation of groups to which G-SII policy measures should be applied. This is what we call entity-specific approach because it's based on the assessment of single companies and the measurement of the impact that the failure of those single companies could have on the market. The second thing in this context, Elise has mentioned, that is to improve the treatment of cross-sectoral aspects. That is, insurance subgroups of banking-led conglomerates, but also banking subgroups of insurance conglomerates. And as Stephen will explain more in depth, in general, there is a need to check whether there are inconsistencies between the two methodologies, G-SII methodology and G-SII methodology. And the third aspect was to develop the so-called activity-based approach. We will try to explain what we mean for activity-based approach, but certainly something that goes beyond the entity-specific approach. There is a common understanding that dealing only with the single large companies, groups, and measuring the impact upon failure of those groups is not enough couldn't be not enough for having an appropriate approach to systemic risk. So those three things, actually, those three need for development actually have been incorporated in the mandate of this task force that I and Stephen are coordinating. There are three work streams clearly defined. Obviously, each of them is interconnected with the others. The first one is to develop the assessment of a systemic risk taking an activity-based approach. The second one is improving cross-sectoral consistency. The third one is to review the methodology. I would actually highlight the advantage that, from an organizational point of view of the establishment of this task force is that we will be able to take into account of all three aspects using an holistic approach, so taking into account of the mutual interaction between the different results that we will then achieve. We will, as I said, we will today focus on the first and the second work stream because those are those connotated by more innovation. But certainly, as Elise said, a key aspect would be also to review the methodology. And I would underline here also the sequence of this task. We will review the methodology when we will have a clearer idea of what will be the design of the activity-based approach, which kind of improvements we have to introduce for taking care of the cross-sectoral approach. So it is expected that review of the methodology will take into account the other two work streams. From a concrete point of view, in terms of work stream 1, that is the activity-based approach, the result could regards policy measures. In this regard, what we are going to do is the following. We will first build or design or agree on what we call a conceptual framework. Why certain activities, which are the activities that should be within the scope of our assessment, and why those activities could have an effect at sectoral level in impacting the system. Based on this framework and after having identifying which are the main categories, at least, of risk exposure that we have to focus on, we will check the current regulatory framework, and we will identify which are the existing policy measures that could mitigate those macro exposure. Obviously, the existing policy measures are there because they have a micro purpose at the moment, that is to reduce the probability of default of the companies, but many policy measures have also an effect in reducing, if you want, the externalities that, those type of exposure could have toward the system. Only after having made this gap analysis, if you want, we will check whether additional measures are necessary to be introduced, or some existing measures should be reinforced, or whether in some way the current regulatory toolkit should be improved. At this stage, I would like just to highlight that we are speaking here about any type of policy measure that could be quantitative, policy measure that could be qualitative policy measure, for example, on risk management and so on, could be policy measure that regard reporting and disclosure of those exposure. And there could be also policy measures that are addressed to supervisors only, in order to, for example, give indication of how supervisors should react, for example, to certain signal coming from the supervisory system. So all the policy measure, all the types of policy measure will be taken into account. So from a more concrete point of view, this is an extract of our work plan. We are obviously at the beginning of our work, so these slides will be very, descriptive without a lot of content, because at this stage we do not have, even tentative conclusion to share. But we thought it was important to inform everybody about this work stream, because differently from the entity-based approach, this approach is something that in principle regards all the sector, all the companies within the sectors. So I think that inputs from all stakeholders will be very, very key, and we will be very keen to listen to inputs coming from all types of companies in the process of delivering producing our deliveries. So in 2017, we have started with the development of this conceptual framework. In our task force with Stephen, we are trying to answer the question. So what do we mean for activities? Which are the activities should be taken into consideration? Do we need threshold? Do we need to introduce some kind of dimensional limits? And above all, why certain activities could impact the market? We'll try to explain a bit better later. Work in 2017 has started also with regard to the cross-sectoral consistency check, and Stephen is leading this work stream and will tell us something later. According to our mandate, we should carry out the 3 work streams and produce a final consultation paper at the end of 2018, okay? In time for revising the methodology in 2019 and applying the methodology for designating insurance companies in 2020. But we thought it was useful to have an interim consultation at the end of this year. So our plan is to issue a consultation paper before the end of the year, likely in November, that is focused on the activity-based approach. This consultation paper is not going actually to present definitive proposal on that, but mainly focus on highlighting which are the issues and which are the questions we should answer. So the main purpose is to get inputs that we will then consider in finalizing our job. In 2018, obviously, we will work on the feedback on this consultation paper, and we will start, as I said, taking into account the tentative conclusion in the other work stream, the revision of the methodology. All the result of the 3 work streams will be included in a consultation paper at the end of 2018. As I said, in 2019, we will have a finalization of our approach, both with regard to entity-specific and activity-based approach. Any measure that we will consider as necessary to be introduced or modified will be integrated in the COMFRAME and or ICPs in the revision of 2019. I think this is more or less, I think it's important that all of you take into account this timeline in order to, also facilitate the dialogue that we can have and the continuous consultation on that. What is the activity-based assessment? Actually, we do not have a definition at this stage to share. I will try to explain. We are actually discussing this aspect. One could think that activity-based approach, first of all, is not the entity-based approach. It's something that goes beyond that. Entity-based approach is assessing what is the impact of the failure of a large company on the system. Activity-based approach is an assessment, an horizontal assessment that spread toward the whole sector about possible impact on the system given by common exposure or correlated behavior of many companies, independently of the failure of those companies. It is easier to say than to actually describe with precision, but maybe and in the consultation paper we will try to explain as deep as possible this concept. What is important to highlight is that activity is a term which is used to differentiate, the approach compared to the entity-specific approach. Actually, we are still looking at reducing the externalities toward the system, but from a different perspective, let's say, without focusing on the single companies, at the failure of the single companies, but looking at a wider set of companies. But here, activities doesn't mean, if I can say, that we are going to make a list of specific products and labeling those specific products as systemic. What we are trying to do is to take into account of any type of activity or practice that could lead to risk exposure that it could have a relevance in assessing in potential impact on the system. So you can have activities that relates to the design of a product, for example, or even an insurance product. You can have certain activities with regard to the management of these products. You can have activities that are relevant with regard to the management of the overall balance sheet of the companies. So we try to focus on the economic effects of those activities independently of whether it is a product or it is a practice or it is an asset liability management. And for this reason, our objective would be also to consider any risk mitigating effects that the company is introducing, is using in the management of each activity. So total balance sheet approach, including risk mitigating mechanism, is the objective. We'll try to develop a concept of activity that meets this objective. Last point, the transmission channels. Here in the slides, we reminded about the transmission channels that have been already identified as the most important in the entity-specific approach. Actually, this is the starting point of our analysis. But I think it's worthwhile to highlight here that we will try to identify which are the activities that are relevant, trying to explain why those activities should be within the scope of our analysis. And for explaining why, we should take into account of the exposure and the potential impact that this exposure under certain circumstances could have on the system by a certain transmission channel. So this is just to remind that we will try to be as analytic as possible in explaining why those activities should be considered in the assessment of the macro risk. As I said, one of the easiest way to describe the activity-based approach is to making comparison with the entity-based approach. In these slides, we highlight some profiles of those comparison. Obviously, as I said, entity-based is based on assessment of impact of a failure of a single institution. ABA is rather an assessment of a potential impact of many failure, many distress, or even synchronized responses of a companies to certain development of a certain market factors. It's very meaningful, I think, to understand the terminology, to understand the difference between the two approaches, the terminology used by IMF in the report. ABA is mainly recognized as a domino, having a domino effect. Activity-based approach is rather a tsunami effect, common exposure, which causes correlated action. And there is also, obviously, as I said at the beginning, a comparison in terms of scope and even in terms of scope of any possible policy measure. Yeah, because as you know, in the entity-specific, the focus is on designated companies rather on the ABA. It should have a wider range of companies taken into consideration. Obviously, we should also answer other questions. which is the range of companies that should be, within the scope of any policy measure that will be identified. Should be all the companies, should be a subset of companies. There is a need for application of a proportionality principle. There is a need of a minimum threshold in terms of dimension of the company or dimension of these activities. Those are all question marks still for us, and we are discussing those aspects. I conclude by saying that obviously, as I said, the third aspect of our work is to review the methodology, and we will review the methodology, as I said, starting from beginning of next year, with the purpose of fixing, taking care of those four needs for revision. The first one is taking care of all the aspects that also Elise mentioned that we already acknowledged had to be reviewed, like, for example, a better measurement of liquidity risk exposure, a better measurement of what we call macroeconomic exposure. There are, however, a number of other aspects to take into account, both related to the phase 2, but also related to the process as a whole, like, for example, the issue of transparency and so on. Obviously, we will also take into account of any experience, lesson learned in this period, in the period of the application of the 2016 methodology. And finally, as I said, we will take into account of the introduction of any regulatory framework for activity-based approach. And finally, we will take into account of any result that we will have in assessing the inconsistency or any inconsistency that we can have now between the G-SII methodology and G-SII methodology. And this lead me to actually ask Stephen to describe a bit the cross-sectoral work that have been initiated.
Sure. Thanks, Alberto. I think I would first start by just thanking Alberto and Elise for their work in this areas. I mean, I think as you saw in Alberto's presentation, a lot of the fundamental elements from the NTNI paper are being incorporated to an aspect in this work. And then Elise and I have been working closely on these issues over the last several years. So I think it's a good recognition of us working together to try to solve these issues. With regards to the joint task force between the BCBS and the IAIS, there is strong participation from both the Basel Committee members and members of the IAIS. And I think there is a strong recognition that both associations need to work together to improve the cross-sectoral consistency between the two various methodologies. And the initial task force had its initial meeting earlier this month, so we're in a more beginning planning stages, but maybe I can just map out some of our near-term outlook and deliverables over the next 18 months. I think in the near term, the first thing we're doing is a stock take of the various work that's been done by both the BCBS and the IAIS with regards to the methodology. The BCBS is completing its 3-year review, similar to us, later this year. And one of the main issues that you see is the disconnect between the treatment of insurance subgroups of banks and then banking subgroups of insurers, and how there's a disconnect between the two methodologies. So that's been one area that we spent a lot of initial focus on. I think the second area is, are there other areas outside of that example where there can be improved cross-sectoral consistency between the two methodologies? Similar to what Alberto said earlier, are there some exposures that are being measured by both associations, whether it be through derivatives, whether it be through some type of short-term funding or securities lending, where we can sort of have a better cross-sectoral consistency there as well? I think the third thing is the group is going to work hard to provide some initial input and feedback to Alberto's group for the Q4 2017 consultation. That's something I think that is important, and we're going to make sure that there are some high-level questions where we can get feedback from the public on some of the elements that are necessary for doing this cross-sectoral work. I just want to sort of emphasize Alberto's point on the stakeholder feedback. We're doing a two-tiered consultation process, which is something I think that's a change from the last 3-year review. So as Alberto mentioned, we have the first consultation in Q4 17 at a higher level, and then we have the second consultation in Q4 18 where you drill down into some of the more specifics. And so I would encourage people to really think about contributing for that first consultation in 2017 as we sort of address some of the fundamental aspects of the work, including, like Alberto mentioned, the scope of the work, how far that extends across the sector, how that extends across the multiple financial sectors. So I just would be able to flag that, I think, for the group to be paying attention to. I think the second element of the task force relates a lot to what Elise was referring to with the methodology review. That's obviously not taking place this year, but that is sort of a longer-term deliverable for the group starting in 2018. And I think one of the lessons learned over the last few years with the methodology is that there is this need to have some improved cross-sectoral analysis in both our product and in the G-SII methodology. That's particularly relevant when you look at the phase 2 and phase 3 of the methodology. Both of those phases do address this issue at a higher level, and I think one of the benefits of the revised methodology in phase 3 last year was we were able to do a deeper analysis as an organization on a firm-specific basis to address some of those issues that Elise highlighted earlier, whether it be reference values or some type of cross-sectoral analysis when we're looking at other financial market activities that are done not just in our sector, but also in the banking and the asset management sectors. And I think also one other thing that I think is important to notice is that there is, opportunities for us to engage with a broader set of stakeholders, and I think Alberto and I are always available to keep, to get feedback where necessary. So I think that something is, don't feel, hesitant to contact us in that regard.
I think, as I said, we are at the beginning of our work, especially with regard to the activity-based approach and the cross-sectoral aspects. So we are not at this stage still ready. We are not yet ready to share a conclusion, but I think it would be a good occasion today to have a question and answer session in order to maybe clarify certain aspects regarding the objective of this work and the way this work will be carried out. So the three of us are all available for any question. Any question? I think you can answer.
I'm Bill Schwegler with Aegon. On one of your slides, you referenced what's called the Tsunami View, which is a common exposure causing correlated or very similar action from a number of firms. I would assume that that's kind of the problem that the activities-based approach would try to address. My question is, if you have an ICS, which effectively measures exposure the same way globally and gives you the same incentives globally for action, does the ICS actually accelerate and cause systemic risk where it doesn't currently exist?
Yeah, we can give personal views about that at this stage. I don't know. Let's start. No, I think any risk-sensitive system, like what is implicit in the ICS, could be procyclical at the end. The important thing is to have additional measures that avoid procyclical reaction from the supervisors. I think you cannot have a risk-sensitive, a good early warning from a system if you do not have, you know, the same way to measure the risk, and therefore to have, you know, a capital requirement that reflects the changes in the risk over time, the change of the business, and so on. I think, in my view, it's important to have this type of approach in measuring the capital requirement. Certainly, this could be, I agree with you, it could be a reason for procyclical effect, yeah. But I think in the system there should be also measure in order to mitigate the effect of procyclical. Yes, I think so. Also because you know, what I said, you know, the activity-based approach is something that should analyze any externalities, and those externalities, in my view, again, this is personal, could come out from risk exposure, but could come out also from other aspects, you know, other situation, and maybe taking care of the you know, procyclical effects of the regulation is worthwhile to do, but I don't know.
The only thing I think I would add is that, similar to what we're doing with the joint task force between the Basel Committee and the IAIS, which is doing a stock take of how they've both handled this subgroup issue, I think as part of the work of Alberto's group and our group is going to be doing a, you know, sort of a stock take of what we have in the ICPs, what we have in ComFrame, and sort of see how that plays in. But I think, as Alberto was mentioning, we're at the initial stage now of frameworking, but that is obviously at some point in the work plan down the road that those issues will have to be considered.
I don't really have much to add. Maybe I'd just say that, you know, you have this issue of procyclicality in almost any capital standard, and you do have to kind of step back and, you know, after you create it, I mean, they haven't even gotten off the ground and created it, but once they do, to kind of take a step back and think about the incentives.
Other questions?
Hi, Joe Engelhardt with MetLife. I have two questions. The first is, I would agree that at this stage you may not have a complete definition of what an activities-based approach might mean, but I would ask if you would consider the derivatives reforms that were taken in the immediate aftermath of the crisis as an example of an activities-based approach, and whether you consider that a valid example of an activities-based approach. And my second question would be, and this was more of a request than a question, you know, you had a good, you know, timeline for what you're going to do and you had a good comparison of, you know, activities versus entities-based approach. But what I didn't see in there was a comparison of which one better treats risk. And I'd use, again, the activities-based approach, which I would consider the first activities-based approach. If you compare the results of that, at the beginning of this panel was mentioned that, you know, the markets are much safer right now. I'd agree that's the case. And certainly to the very tangential extent that insurance was a part of the last crisis. The reason, at least I would argue, that markets are a lot better right now is that derivatives was the main problem that AIG had in terms of the big numbers, the exposure. Because of the reforms that were taken in derivatives, you know, better transparency, reporting, requiring of central clearing when possible, better collateral behind that, you know, defined haircuts based on the type of collateral. If AIG would want to do the type of activity that back then, they have to register as a swap dealer, be subject to all the capital requirements of basically a broker-dealer bank-like entity. So it's true markets are a lot safer now, but it's, you know, I'd say at least in that particular area, because of the reforms, this activities type reform that's taken place. And if you compare it to the G-SII methodology, it's still just looking at the gross notional exposure of derivatives AIG would not have stood out in 2006 under that criteria, even though it was, taking a lot of one-way risk. So if you compare those, two approaches, which one's really treating risk better? So would you consider that as a good example? And again, be open to some type of comparison about which one better treats risk? Thank you.
No, I can say that maybe it's, yeah, I think it's a good example, but it's too early to say how those considerations will be embedded. As I said, we will try to have, as far as possible, an economic approach to the issues. One of the challenges is that if you want to use an economic approach, you want to measure, and you need to measure those exposure. You need to have an appropriate metric for doing that. Possibly, a metric that is applied worldwide, and have an economic basis to do that. But I think at the moment we cannot say more. I don't know that.
You don't have to answer the second question now. Just please be open to that. Thank you.
Jeff Alton from CNA. I appreciate the presentation. I mean, CNA is IIG and not a G-SII. And CNA and a lot of other companies in the same situation are very interested in the activities-based approach and trying to get our heads around it. So I'd like to scratch, if I could, a little bit on that tsunami effect. I mean, is the tsunami effect the only reason you're exploring the ABA, or are there situations where you could have going concerns that could have systemic risk?
I don't know whether using tsunami was a mistake or not.
I don't think it is a mistake. I mean, we've been bringing up, we've been trying to get our heads around this for a while.
But again, I think at this stage we can give just personal view. I think everything goes beyond the failure of a single institution. It should be taken into account. So also.
I mean, when we first became aware of...
So also ongoing.
For going concern? Because I think from our perspective, we're thinking, I mean, when systemic risk first came into existence after the crisis, I mean, it was done under the premise of too large to fail. And that too large to fail could have an adverse impact on the real economy, so that isn't good for the real economy and we need to address it, which is the entities-based approach, and we're all comfortable with that, right? And now we've kind of morphed into this ABA approach, and so you try to make correlations between the entity-based approach and the ABA approach to kind of reconcile where we're headed. And I think, at least from my perspective, I've always gone to the tsunami approach. Because if it's not the tsunami approach, and I'm not saying that that's correct, but it's the tsunami approach, because if it's not the if it's not the tsunami approach, that means that there's something the entire industry is doing that's having an adverse impact on the real economy, and they're going concerns. And so I would argue that the ICS or jurisdictional regulation should address that, because that's bad for policyholders, it's bad for everybody. So that's not systemic, that's just business practices. So that takes me to really the ABA, and I'm not trying to put words in your mouth, I'm just trying to understand. The ABA is really trying to take care of the tsunami effect. And that is that the industry unto itself, so each individual firm may not be large enough to impact the real economy, but if there is a catastrophic insolvencies, and they all go insolvent, let's say 1,000 insurers go insolvent, that could have an impact on the real economy. Is that where you're going?
I think independently of the failure of the 1,000 companies, you can have theoretically effect on the system if there are, for example, a common reaction to certain event by many companies, depending on the common exposure that those companies could have. I agree with you, however, that there are already measures, the ICS and the risk management standards that should mitigate those effects. And this is actually what I consider part of the ABA. So,
Okay.
so the policy measures that we are speaking about are not necessarily additional policy measures. Could also be policy measures that mitigate micro risk, but at the same time, you know, reduce the possibility to have a common effect on the system.
But that would mean that these 1,000 insurers are highly correlated and are, and I guess,
For example.
For example. I mean, but the issue that I think conceptually where I'm having a problem is that one of the problems that we're having with the ICS is because of the diversity in the industry and that our business plans are all, geographically we're writing business in all over the planet, but not all in the same places, and we're writing different products, and none of us are writing in the same way. There's not like a boilerplate. And so that's the problem we're having with the ICS. And now we're in the ABA, and we're under the premise that we all do exactly the same thing. I mean, in the modern regulatory era, which I've titled, right, is post-World War II, there has not been major insolvencies in the industry. We may have in each jurisdiction one or two. So the concern that I have is that if this ABA, and forgive me for being glib, sounds like a solution in search of a problem from the standpoint of, is that it's, at least from our perspective, it doesn't seem probable that 1,000 insurers are all going to go insolvent at the exact same time. And if 1,000 insurers don't go insolvent all at the same time, then why are we going down this activities-based approach? If it's based on activities that firms are doing and their going concerns, then from our perspective, that should be addressed in the ICS, and that's public policy at a jurisdictional level. But if it has to do with only the tsunami effect, where there are mass insolvencies, 1,000 or more, which has not happened at least since World War II, and if you're in a mark-to-market environment, I mean, excuse me, if you're at amortized cost, we want to talk about valuation, we're all not going to act the same way because we're not forced by artificial influences, which I think was what Bill's point was. And so I guess, are you going to consider these facts? Is there going to be like a cost-benefit analysis to say, we've generated this academically beautiful model here, but the probability that it's ever going to happen is remote, and the cost of firms to implement is excessive. So is that part of your process? And is my thought process also heading in the right direction of where you're going?
Yeah, I think I can say that this is part of our, you know, the issue we are considering. We will consider, you know, having you know, an activity-based approach doesn't mean that we should create additional rules that apply to all the companies, you know. But the objective is to be sure, and this is something that is done in many jurisdictions, not only at the global level, to be sure that the current toolkit includes, you know, the right macroeconomic measures that could avoid certain tsunami, the effect of certain tsunami effect. But
I don't think of an activities-based approach and the tsunami effect in particular as being sort of only the situation where you've described where, you know, all the companies go insolvent. They may not go insolvent. And it's really taking, you know, looking at it in terms of its impact on the system. So they could not be insolvent. You could have your risk-based capital and they're all acting in a correlated way and has an impact on the system. And that's, you know, this is the aspect that we're looking at. And it may well be, as you say, like the micro measures may go a long way in sort of addressing it. But I think my understanding of what's being looked at is there something additional that should be considered in terms of a policy measure that takes account not just of the company-specific risk, but when the companies are acting in concert, will have an impact on the system.
Hi, I'm Bernie Birnbaum with the Center for Economic Justice and Consumer Representative. So could you bring up a couple of slides back? Go back, I think, to comparison of the activities versus the entity-based. Yeah, this is it. So before I ask my question about that, I wanted to just sort of weigh in and say that we have actually had experience where entire industries, entire sectors of the insurance market failed. The private mortgage insurers failed. The bond insurers failed en masse because they were all engaged in systemically risky activities as a group. We've also seen the same thing with mortgage originators and lenders who were engaged in systemically risky activities, and as a group that was transmitted into the system. So I sort of fundamentally disagree with the dichotomy that Jeff has sort of put forward. But in terms of the activities-based assessment, I can see where the activities-based assessment would capture things that AIG did. If you were doing an activities-based assessment, you would have captured their huge credit default swaps. You would have captured their huge mortgage securities lending as sort of activities that posed risk. So my question is, what is there in the entities-based approach that wouldn't be captured in the activities-based approach? I mean, it seems to me that activities-based approach would capture any problems that you would identify with large companies, but what is it that in the entities-based approach that you wouldn't be able to capture with the activities-based approach? So that's question one. The second question has to do with, as you engage in the activities-based approach, what is the role of kind of competitive analysis or antitrust type of analysis in terms of how that affects activities? And then the third question is in terms of measurement. In the discussion earlier today about the ICS, there seems to be a real, the reference is elephant in the room about how you measure liabilities and how you measure that on a global scale. So there are clearly issues about measurement, which is a pretty important aspect of something that you're trying to use as a metric for comparison. With the activities-based approach, it seems like that kind of measurement was fundamentally easier. I mean, if you're looking at, say, if you're looking at the what life insurers around the world are doing in terms of promising market returns or lack of sort of principal loss, that's pretty easy to measure if you have the data to do it. So isn't one of the advantages of the activities-based approach a much more straightforward ability to sort of measure the things you're looking for compared to the entity-based approach? Thanks.
Should I start? The first question, actually, the IMF in its report highlighted what is, for example, missing in an entity-based approach, and that would not be captured by the entity-based approach. There are possible effects that are not related to the failure of a single company that could impact the market, and this is the complement that we are dealing with now to the entity-based approach, going beyond the effect that a single institution, the failure of a single institution could have, and looking at whether a wider range of companies, not necessarily insolvent, could have on the system, and this is what we are trying to do, and for doing that we are still discussing whether it should be as I said, the activity considered as a specific type of products, or should be rather better to reflect, to make reference to the exposure, the risk exposure of those activities could have. To be honest, I forgot the third question. But yeah.
Just to comment on that particular question, it's really, until the activities-based approach is actually developed and we see what it looks like, it's a little challenging to answer your question, because I could conceive of a very elegant design of an activities-based approach that would capture the situation of a company that's has a large market share or a concentration in a particular activity. So it's possible. It's possible. It will depend on the design of the approach that it could capture like the types of risks in AIG and the concentration of activities that they had and their derivatives and some of the other activities that cause the problem. So I think we have to wait and see.
And
Thanks.
indeed, as I said, we will review the methodology after knowing which is the design of the activity-based approach.
Okay, thanks.
Okay. We have another question there.
Thanks. My question is, do you think that an activities-based approach should be agnostic to the type of institution we're talking about? Obviously, in terms of regulation, we're siloed in terms of bank regulators, asset management regulators, insurance regulators. But if you were to take, say, the BCBS approach or other based approach for other financial institutions and their approach to activities, could you not just apply that to insurance? And the conclusion might be that insurance is obviously a lot less systemic than banks or asset managers. How much of this needs to be insurance specific, and how much of it can it be agnostic to the institution and just think purely about the activities, which could be a bank, a hedge fund, or an asset manager?
Yeah, this is a good question, and I think we will take into account what are they doing in terms of activity-based approach in other sectors, but we will check whether those aspects are consistent with the business model of insurance. So I don't think it's a question to be agnostic or not on the issue. I think if the risks are genuinely the same, we will try to ensure that there are no inconsistencies. If there are differences, I think we will define something which is more suitable for insurance. But in developing both the activity-based approach, as we are doing in the entity-based approach, we should take care of what is the treatment of those exposure in other sectors. Yeah.
Mark Hadis with Zurich Insurance. I think a fairly similar question, actually. On your slides, when you talk about cross-sectoral consistency and the improvements, I only see BCBS. So I understand, you have that situation with the banks and probably the banks with insurers to some extent. Yeah. But you have asset managers as well. So where's IOSCO? Yeah. And what is the role of the FSB in this whole exercise? Because I think the FSB would be the prime actor in terms of cross-sectoral focus above the whole financial sector. That's one, and I think rejoining the question of the gentleman of Insurance ERM, when you look at what's happening for banks, you have the entity-based designation, there's some macroprudential framework, but I don't hear them talking too much about the Tsunami View. Whereas for the asset managers, we probably hear more about the Tsunami View and nothing about the Domino View. If you could elaborate on those points.
Yeah, maybe one slide was misleading under this point of view. Obviously, cross-sectoral aspects takes into account all the sectors. And when we speak about the activity-based approach, we will take into account also the asset management. We mentioned the BCBS because we were referring to the entity-specific approach. which is developed at the moment only by Basel Committee. The FSB will be, I don't know what, Vicky, the FSB, as always, will be, reported about the development of our conclusion in the treatment of systemic risk. And the FSB has endorsed actually this project.
And so for the joint task force with the Basel Committee, I mean, I think that is a concrete project that can begin now. There are existing methodologies. Each are reviewed every 3 years. Each are measuring similar exposures, yet they're doing it in slightly different terms, and you have the subgroup issues. So I think the idea is that is a concrete project to start with. And then as Alberto mentioned, there is obviously the larger financial sector that needs to be incorporated with IOSCO, et cetera. But I think for this task force, it's really just starting at, we have these indicators, they're called the same thing, yet maybe perhaps the data is not measured the same, and there is this sort of inconsistency between the subgroup issues. So that's, I think, where we're starting. And then like Alberto said, that's a broader financial sector question which needs to be addressed.
I mean, what would be ideal, obviously, is like if you looked at activities which happen across the board, right, and you obviously rank them across the whole financial sector, and I think that was the point, not within the silos.
All those questions are not unexpected. Actually, I should confess that also at the beginning of our work, we are spending much time in having a common understanding of all those aspects because it's a new concept, even though it's not completely new, but the implementation of this concept is new, and we are very keen for this reason to get the inputs from all the stakeholders. For this reason, we decided to plan this interim consultation because it's not easy to design a clear framework, and as a consequence, it's not easy to take policy decisions which are focus on the problem without creating unjustified, undesired effect on the companies. You cannot refrain from...
Can't save myself. Bertie's not here to drag me away. So I thought that the way that IRS did ICP 12, where they issued that pre-draft, and then a lot of the stakeholders got to respond, and then we met, talked through some things before the final consultation draft was exposed, was excellent. I think a lot of us still have some concerns about where he sits currently, but that's natural. But as far as that paper moved from the moment when it came out in a pre-draft to when it was exposed was tremendous and addressed a lot of the industry comments that really hadn't been considered. And so I would just request that you do a similar model for this, because I would think that the interest in this issue is as big as the issue is on resolution and recovery planning.
I think the interim consultation goes in this direction, actually. The interim consultation, as I said, will not present a conclusive proposal, but we'll try to highlight which are the issues and what we think should be the answer to those issues. And we will try to also to have other moments for a dialogue. But maybe Vicky can elaborate.
No, given that, Alberto, you turned to me, I feel that I should respond. On the process, you're absolutely right. That's why we have 2 points. As Alberto said, at the end of this year, we're going to issue an open paper, a more sort of issues paper that looks at more conceptual issues, and we will take a lot of feedback from yourselves. And then end of next year, we're going to issue the consultation paper with, again, we'll take feedback before arriving at a policy. I just want, on the questions that were asked before, some thinking. You're absolutely right that so far in the asset management sector, first of all issues around systemic risk are obviously overseen by the Financial Stability Board across sectors, quite rightly so. With the specific work on a particular sector then being led by the responsible standard setter. So it's quite clear that in assets management space, the FSB and now IOSCO is developing the standards, have opted for an activities-based approach around targeting potential liquidity risks and risks from leverage, particularly from synthetic derivatives. It is also quite right to say that in the banking sector, my colleagues at the Basel Committee have opted for an entity-based approach that has been operating for some years. However, it is not right to say that they've never done an activities-based approach. They've done it, but they don't call it this way. And I'm also a member of the Basel Committee as well, so I can assure you about that. They have a capital adequacy standard which applies to all banks, so across the sector, and within that they apply, for example, higher capital requirements to intra-financial exposures than exposures that are not amongst banks and other financial companies. The rationale for doing so is because they see intra-financial exposures being a systemic activity. So within the capital standard, they also incorporate systemic measures. So this is an example of how they have incorporated within capital adequacy. The Basel Committee also has a liquidity standard, a quantitative liquidity standard. Its rationale very, very much is systemic. It's in order to prevent asset fire sales to take place. So it's not called an activities-based approach, but it tries to capture these issues. Sometimes the standards are called microprudential because microprudential supervisors take them, but they really are targeted to the system as a whole, to these particular sectors. And finally, in a more sort of qualitative space, the Basel Committee has a large exposure standard, which is likely to capture concentration risk. It actually has different limits when the exposure is from one systemic bank to another systemic bank, again, within a large exposure framework that applies to all banks. They don't call it an activities-based approach, but it is an activities-based approach. So actually, the banking sector has very specified complementary activities-based approach and entities-based approach. Now, where are we on insurance, which is our sector and where this association has responsibilities? The process is being described very well by my colleagues on the panel. But really, in insurance, it is absolutely the case that when we first devised the entity-based approach, we're trying to capture not insurance activities, we used to call them traditional, but not activities that will not pose any risk to the system, regardless of whether the company failed or not, but activities such as intra-financial activities that did pose risks to the system. And we gave much higher weight to those activities than let's say, to size in identifying companies. Now, with the activities-based approach, we're trying to look at a broad range of activities, then see whether the existing policy measures, including ICS, but including the derivatives reforms, including what IOSCO is doing on asset management, are going to capture those, and then seeing whether there is anything residual to be left when we revise the assessment entity-based methodology. And that describes the sequence of our work. And separate to that is the work stream that Stephen said, which is much more specific. It's about a cross-sectoral consistency the joint work with BCBS and IAIS. But that's the broad framework, and that's how I see it cross-sectorally. Thanks.
Thank you.
And finally, the FSB, of course, has welcomed the approach that we are taking, just to confirm what Alberto said.
Thank you, Vicky. Actually, yeah, I think this was not maybe clear from the presentation. There is a specific work that we are dealing with the joint work, the joint group Basel Committee, IAIS, with regard to the methodology and for designation, but the cross-sectoral dimension will be taken into account also with regard to the activity-based approach. I see that we are running over time, and so I would close here the panel, and I thank my colleagues and all of you for the attention.
Yeah, thank you. So thank you very much. Taking out of this session, I assume that people understand we are still quite initial stage of this ABA discussion. As Alberto stressed, in November, we are going to issue first consultation paper where we formulate our view, but it's a rather open consultation paper. So as you did today, we really much appreciate your comments. And as you can learn, as we learned, that this cross-sectorial issue is very important, and Vicky stressed that it could link to not only sort of existing GSII or IAIGs, but all companies might be related to this initiative. So watch carefully our development, and we really appreciate your comment in coming months. So the break will take place just next. The coffee will be served in the vis-a-vis this room, and we will meet again at 3:30. And one important information, some people ask, slides that we present here is quite relevant information. We will put on our website. So after the meeting, you can visit our website, and slides will be there. So thank you.